That is undiversifiable risk. What a misnomer! What a misnomer, because just because it is a principal direction of risk in this market, specifically US equities, it does not mean you can't diversify it away or include strategy to diversify it away. What an incredibly important idea that academia just completely misses. I'm like horrified to hear finance majors coming out of university and say, oh, market risk is undiversifiable. I'm like, yes, but we have strategy derivatives. We can do so much to improve our long run portfolio growth. We're not just stuck here. This is exactly what I talk about in my live class, where I teach you how to run a personal hedge fund. It's an asynchronous course available on quantguild.com. I walk you through everything from A to Z. This idea of optimizing your risk and return, the idea of market crisis and crash alpha, how to generate that in a portfolio with different sleeves and allocation and different strategies that I even run on my own personal portfolio. So if you're interested in that, I will again leave a link to that in the description below. I highly recommend you check out that class if you're interested and you run your own portfolio. But if nothing else, definitely please check out that free quantitative research note where I do outline more specifically this notion of broader market risk. You should 100% understand the risk that you and your portfolio is exposed to, whether it is a specific market or different markets, and whether or not you are diversified. Okay, because the notion of diversification mechanically does break down, and that's exactly what we're approaching now. This notion of undiversifiable risk can be measured with the CAPM regression. The CAPM regression is simply going to regress the portfolio returns, whatever your portfolio is, on the market returns. You're going to get a number, and that number beta will tell you how sensitive your portfolio is to the broader undiversifiable market risk. The market risk is just the wind blowing. You don't get to dictate the direction the wind is blowing. You go through inflationary periods, deflationary periods, expansionary periods, contractionary periods. You don't get to choose that. Nobody does. It would be really nice if we could, but you can't. And nobody knows what's going to happen next. Nobody knows if there's going to be a crash or a crisis. Nobody does, right? We're all just trying to position for our long run survival. If you take a look here, what you're seeing is on the left, this green dash path is the market portfolio. You can think of the S&P 500. You can think of a well-diversified portfolio of stocks like we have here. The blue path is going to be our portfolio. And maybe we're a stock picker, or we think we have a great portfolio. And you can see that it's really just tracking the market. And that's what this regression is showing us here. This regression line having a slope greater than 1, this dashed line here is just a slope of 1, we can see that our portfolio is overly sensitive to the market, which means if the market goes up, our portfolio goes way up. If the market goes down, our portfolio goes way down. And the problem is with volatility drag and this idea of geometric returns, what does that mean for our long run wealth? It means that we're dragging our portfolio. Every time we have a drawdown, think about like a 10% drawdown. It takes more than 10% to recover from that drawdown. That's a consequence of the geometric compounding of returns. You see this volatility drag and that notion of requiring a greater return is exactly why you can't chase ephemeral high returns at the cost of volatility for long run wealth. That's not how you generate long run wealth. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, QuantGuild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half. improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.